Hi, if you're new, welcome. If you're not, welcome back. This is the beginning of a brand new episode where I'll be explaining everything surrounding monetary policy. Make sure to leave a like and subscribe. This channel is still brand new and it would help us out enormously. Let's get started. Unless you've been living under a rock the past year, you will have heard something about printing money, interest rates, government bonds, or even quantitative easing. In this series, we'll be discussing all of this and more one at a time. First, it's important to distinguish between monetary policy and fiscal policy. Fiscal policy refers to government taxation, which gives the currency value, and government spending for politicians' re-election campaigns. Monetary policy, on the other hand, refers to the central bank controlling the supply and velocity of currency to achieve macroeconomic policy objectives, such as full employment, stable economic growth, and price stability. I'll get into all of this later in the episode. You will find out in this series about the benefits and the many drawbacks of these monetary policies. Before you get a solid grip of how monetary policies work, we must go all the way back and understand the fundamentals of money and currency. Forget everything you've ever learnt about money, because in this series I will, for instance, never refer to the pound or the dollar as money, because it isn't. There's one fundamental difference between money and currency. While they both share the properties of being a medium of exchange, a unit of account, portable, they're durable, they're divisible, and they're interchangeable. However, this is where there's the fundamental difference between money and currency. Money is a store of value. This is because money is limited in supply, so the purchasing power stays stable. Now you must be asking, how is money limited in supply? I've heard the Fed has been printing trillions back there in the US. Well, the Federal Reserve, they've been printing trillions in dollars, which is not money, it's currency. The dollar is not tied to gold or silver or any other stable asset. It's just another currency. Let me explain to you in this way. Picture going to the dry cleaners. You hand in your shirt and in return you get a claim check. That claim check is worth the amount of the shirt. Because if the shirt, for instance, costs £50, another person might buy that claim check and therefore the claim to the shirt for £50. The claim check is basically the money in the economy and the shirt is the commodity to which that claim check is tied. Now imagine that the shirt got stolen, so the claim check does not have an asset tied to it. It is now basically worthless. The only reason why that claim check could have any value at all is because either you speculate that somebody else would want to give you something in return for that claim check, or because the dry cleaners tells you that if you don't give us part of that claim check, we will put you in prison. In today's world, every single currency is a fiat currency. Fiat, loosely translated from Latin, is an authoritative order or official decree, and has, according to the US Federal Reserve's own words, no intrinsic value and only relies on confidence in that currency. Just like the example of the claim check, the only value it has is confidence that somebody else might offer their goods and services in return for the currency. And the reason for that is because the government will put you in prison if you don't pay taxes in that exact currency. It's simply a fraudulent con game. Why do I go as far as calling it a fraudulent con game? Well, stick around in this series and you'll find out exactly. This sounds scary and doomed to fail at some point. So let me ask you a question and feel free to pause the video to think about it. Has any currency which has not been backed by a stable, limited supply commodity ever survived? Short answer, no. Long answer, never. This is almost always because the currency is not a store of value. If you talk to a Keynesian numbnut, they will most likely tell you that expansionary policies, I'll get into that term later, almost always work when it comes to boosting the economy and achieving macroeconomic policies. What they seem not to understand is that those exact policies have caused the US dollar to lose 95% of its purchasing power since the creation of the Fed, and have caused the Weimar Papiermark to lose 100% of its purchasing power. The Zimbabwean dollar also lost 100% of its purchasing power, and the same for thousands of other currencies. Is the US dollar suddenly an exception, and we can keep pumping out those Keynesian policies? I don't think so. We will get into the nitty-gritties behind all of this and its effects in the later episodes, but for now, let's take a step back and focus on the simplest terms in monetary economics. If you don't understand these, it will be hard for you to follow this series. Let's start off with expansionary monetary policies. In simple terms, it is increasing the currency supply and its velocity of circulation. We have seen expansionary policies all around the world after the 2008 Great Financial Crisis and especially during the pandemic this last year. Expansionary policies include quantitative easing, lowering interest rates to banks, also known as base rates, and reducing the reserve ratio. These policies especially intend to boost consumption and investment, which shifts aggregate demand outwards. This usually causes a rise in the price level, also known as inflation. This is especially effective if inflation is low and the economy needs a boost. Contractionary monetary policies, however, are the exact opposite of expansionary policies. Its aim is to decrease the currency supply and its velocity of circulation, which reduces inflation. This shifts aggregate demand inwards. This, for instance, is achieved by decreasing the rate of consumption and investment. There are three main macroeconomic objectives which I've talked about, and they include unemployment below 6.5%, annual GDP growth of between 2 to 3%, and core inflation of around 2%. Let's discuss these 3 points. There is a common misconception about monetary policy trying to achieve full employment. This is not very accurate. As mentioned above, one of the aims is to keep unemployment below 6.5%. However, it is also important to keep it above a certain level, no matter how cruel it sounds. Too little unemployment will cause wages to increase drastically, risking a sudden increase in inflation as the velocity of circulation and the supply of money increases. The low supply of unemployed labour, which also causes the high cost of labour, will cause the cost of labour to be higher than the value that the labour brings. In perfect circumstances, these two should be equal. In terms of GDP growth, as I mentioned, GDP growth shouldn't be too rapid, but it can't be too slow. If GDP growth is too low, the rate of standards of living increasing will be very low, unemployment will usually rise as foreign direct investments will decrease, and inflation will usually slow down, or even cause deflation. On the other hand, GDP growth being too rapid can also have many drawbacks, such as, for instance, an increase in inflation as the velocity of circulation and the supply of currency increases. I'll go into more depth about inflation in later episodes, so I'll explain the basics right now. Most countries operate on the CPI, the Consumer Price Index. The CPI is a basket of the most commonly purchased goods. These goods are mostly weighted and determined by phone surveys. The change in the price of those goods then determine inflation. In reality, it is of course way more nuanced than this, but this will do for now. One of the advantages of inflation is that it encourages borrowing, stimulating economic growth. Imagine this scenario. Person A gives person B a loan of £100,000. Person B promises to pay that back with a 2% interest after 30 years. So person B is now £102,000 in debt. In real life, this will be paid monthly, so this example is slightly exaggerated, but it shows the power of debt during inflationary times very nicely. He can now use those £100,000 he borrowed to buy a house which appreciates 2% per year. If inflation is 2% per year, the house will be worth £180,000, but his debt will still be £102,000. So person B's net worth increased by £78,000, while person A loses 45% of purchasing power. Inflation therefore hurts lenders but benefits borrowers. This, as mentioned before, stimulates the economy. Excessive borrowing can, however, also cause a few drawbacks. For instance, causing the biggest financial and governmental crisis in modern history. However, once again, that's a topic for a later date. Another term of what you must understand, and the subject of what we will be discussing next time, are interest rates. What you will have been told in the economics lessons is that it is the amount that the lender gets in return for lending you the money and is determined by the opportunity cost of the lender and the risk that the lender runs by lending you the money. Basically, it's the cost of borrowing money. In monetary economics, however, the interest rate usually refers to the base rate. It is the interest rate that commercial banks such as Barclays pay the central bank for loans. In March, you will have heard that the Bank of England cut interest rates to 0.1%. This does not mean that every bank will now offer you a mortgage with a 0.1% interest rate. Banks of course need to make a profit, as they are paying that interest rate to the central bank. You will more likely get a 4% interest rate. The bank always wins in this fraudulent game. This series will explain why this system is fraudulent by explaining all things surrounding monetary policy. And yes, I did just imply that monetary policies are causing the current financial system to be fraudulent. I hope you enjoyed this little introduction. If there's still anything you're unclear about or have any constructive feedback, I'll be glad to hear it down below. I'll respond to as many people as possible. And do suggest improvements. This is still my very first video, so anything will help. Please like and subscribe, it would help us out enormously. Thank you and see you next time.